Good morning, and thank you for joining the Burness Paul Junior Energy In-House Lawyers webinar series. Our webinar today is an overview of joint ventures and corporate structures in the renewable energy sector. My name is Rory Henretti. I'm a senior associate in Burness Paul's energy team, focusing on M&A and joint venture transactions. I'm one of today's speakers, and I'm joined by my colleagues Sarah Milne and Ellie Chenery. Before we get started is just a little bit of housekeeping. Once you have joined, please can you ensure that your mute button has been selected just to limit the background noise. Today's webinar won't be interactive, so please do contact myself, Ellie or Sarah if you have any questions. Our contact details will be available on the slides that are circulated after the session. Today's webinar will be recorded, and if you have any queries on that, please do check out our privacy policy on the Burness Paul website. So what are we going to cover in today's session? Today, we will look at the benefits of a joint venture. We'll also take you through some of the common uses of a joint venture in renewables transactions and in renewables projects. We'll also explain the different types of JV structure which are available, and we'll then spend some time working through some of the key commercial terms and areas which are often subject to discussion and debate. Finally, we'll then look at the funding and financing of a JV, explaining what helps to ensure that a JV is considered bankable by a lender. So first of all, why do parties enter into joint ventures? One of the key reasons is to share risk and cost. This is an important consideration when it comes to the renewable sector, given the long-term and capital-intensive nature of these projects. In the case of an offshore wind project, multi-billion pound investment is often required. By sharing cost and risk through a joint venture, potential partners can access larger projects while sharing the financial exposure. At the other end of the scale, entering into a JV is also desirable for many smaller or less experienced partners who may not have the financial capability to deliver a project without partnering with a larger player. For example, you might see a landowner partner with a utility company in an onshore wind project. As well as being able to share the costs and risks, partners will also benefit from pooling their skill sets in a JV. Combining the partner's knowledge and expertise is a key benefit to a JV, as one partner may be able to bring specific engineering or technical strength to the table, while the other could bring their project finance capability. Joint ventures also play a crucial role in enabling companies to pool resources to develop and deploy new technologies and infrastructure, which will ultimately assist in speeding up the transition to cleaner energy. Finally, a joint venture can be an attractive option for new entrants to a local market. A JV can act as a vehicle to facilitate that growth for an overseas entity who might partner with an established local company who can help them navigate a new territory. So joint ventures have a variety of uses. Possibly the most common type of joint venture in the sector is for a one-off project, which allows partners to collaborate on a single initiative. The partners will work together to bring the project to FID or its operational phase before a buyout or an exit might take place, bringing the JV to an end. This is the natural option for companies that want to keep their core business operations separate from their participation in specific projects. Where parties are looking to explore multiple projects together, a holding company structure can be established, with individual project SPVs sitting below the holding company. A JV agreement would be entered into at the holdco level, which would then act as a framework for each of the project SPVs. Often, there can be scope to negotiate some project-specific terms which will apply to each SPV depending on the nature of that specific project. This structure allows for easier portfolio management, with financing and risk containment being limited to each individual SPV. JVs also play an important role in portfolio development and building an acquisition pipeline. JVs which are structured for portfolio development may focus on building a pipeline of similar assets, which enables the partners to benefit from the economies of scale in the development and operation of these assets in order to improve a financial return across the board. This can also be helpful for a smaller developer with an earlier stage project portfolio who may partner with a larger or acquisitive developer to help fund this development program with rights of first refusal for that larger developer to acquire the projects later on down the line. So where specifically in the renewable and net zero sector do we see joint ventures being entered into? As I mentioned earlier, a JV structure is very common in offshore wind due to the capital intensive and long-term nature of the projects, and sometimes this is also helpful when there's emerging technologies such as floating wind involved. This can result in the need for multiple partners, each making a valuable contribution. Currently, around 70% of the large-scale UK offshore wind capacity is being developed through joint ventures. In the technologies of onshore wind, battery, and solar, we also see portfolio developments with smaller developers team up with larger, well-funded and experienced developers or utility companies to help to fund development with exit points at ready to build or FID stage. In emerging technologies such as carbon capture and storage, a JV can be particularly useful in allowing for pooling of resources and expertise. If a developer is wanting to move into the market for a new technology, they may not have the background or skill set to fully run this project on their own. A JV will allow them to draw on the knowledge of a more experienced partner in this field. So looking at the different types of joint ventures in some more detail, we have corporate joint ventures and commercial joint ventures. A corporate joint venture will involve the JV partners establishing a jointly owned legal entity to carry out the joint venture activities. The most common vehicles for doing so are limited companies or limited liability partnerships. As the names might suggest, one of the main benefits of using a limited company or an LLP is for their limited liability status, which restricts the liability of the JV partners. The limited liability status of a limited company or an LLP is a significant benefit for mitigating risk, as the liability of the JV partners, for example, as shareholders in a limited company, is restricted to their total investment in the company. A corporate JV, whether it's a company or an LLP, will have separate legal identity to its partners, which means that it can contract in its own right, whether this be through the acquisition of land rights via options, purchases of land or entering into leases, or entering into funding arrangements such as raising debt or granting security to a funder. As a result, the JV partners are, to the extent of their investment, essentially insulated from any negative consequences of the JV company's activities. Therefore, in an insolvency scenario, the JV partners would not be on the hook to settle the JV's debt once the assets of the JV had been exhausted. At this point, it's also worth remembering that entry into a joint venture can fall within the scope of the National Security and Investment Act. It's important to bear this in mind at the outset of any potential JV arrangement, given the impact that NSIA can have on transaction timescales. The other type of JV on the slide is a contractual joint venture. By contrast, contractual joint ventures do not require the partners to establish a separate legal entity. Instead, the partners will enter into a contract such as a cooperation agreement, and the terms of such cooperation agreement will govern the roles of the JV partners. The key distinction between a contractual joint venture versus a corporate joint venture is that the JV will not have separate legal capacity, meaning that JV cannot contract in its own right. Therefore, separate arrangements would need to be made for the examples I mentioned before regarding land, funding, and general contracting. As a result, raising funding can be a challenge for contractual joint ventures. This can be difficult. This can lie in the difficult nature of identifying the roles and responsibilities of each partner and how this will interact with any financing arrangements. As a result, we don't typically see a contractual joint venture used for the development of projects in the energy sector. However, parties may establish a collaboration agreement to explore potential opportunities to work together to identify possible projects, with long-form corporate joint ventures being entered into thereafter. I'll now hand over to Sarah, who will move on to discuss limited companies and limited liability partnerships in some more detail.
Thanks, Rory. So as Rory mentioned, I'll be discussing limited companies and limited liability partnerships in a little more detail. You'll all likely be familiar with what a limited company is, and it's definitely the most appropriate vehicle to operate a joint venture. And this also makes it the most popular, especially in the context of larger JV projects. It will involve the JV partners establishing a new limited company in accordance with the Companies Act and registering this company with Companies House. As with any limited company, there are a number of standard compliance and admin requirements, such as filing annual accounts, maintaining statutory registers or company books, and other required filings, such as filing confirmation statements at Companies House. The relationship of the JV partners is typically governed by two legal documents. You have the Articles of Association, and this is a public document that is filed at Companies House. And then you also have the Shareholders or JV Agreement. And this is a private document that sits behind the company. And for the avoidance of doubt, this doesn't require to be filed at Companies House. Put simply, within a JV company, the day-to-day management is carried out by the directors who represent the interests of the JV partners. And in most cases, the most strategic decision-making is then reserved to the shareholders. So we then also have limited liability partnerships. Alike to a limited company, an LLP is still a distinct legal entity which JV partners establish and conduct the JV's business through. The LLP will also need to be registered at Companies House and to file annual accounts along with some other standard admin requirements. There are a number of similarities between an LLP and a limited company, but an LLP is definitely a less common means of creating a JV. There are some key differences to also be aware of. So an LLP requires at least 2 members, and an LLP member is typically involved in the management of the LLP and will carry out functions that the board of directors would usually carry out in a limited company. This obviously differs from a shareholder of a limited company, which tend to be a lot less involved with the management of the company. There's no equivalent requirement for articles of association to be filed at Companies House for an LLP. However, it is good and common practice for the parties to enter into an LLP agreement, whereby the members are free to agree their own arrangements in respect of the JV. In the absence of an LLP agreement, or where an LLP agreement is silent on certain provisions or badly drafted, an LLP will then be governed by the default provisions set out in the Limited Liability Partnerships Act 2000 and the Limited Liability Partnerships Regulation 2001, which, for example, provide that the LLP's capital and profit are shared equally between the LLP members. So on to accounting. So whilst accountants are definitely better placed to advise on this area, it's worth being aware that the accounting and tax arrangements for entering into an LLP do require some further consideration. For example, an LLP does not have any share capital, so it therefore cannot be part of a UK tax group. An LLP is also tax transparent, meaning that it doesn't typically pay taxes, and instead the LLP members will pay tax on their sums received from the LLP. Finally, it's also worth noting that one of the main reasons we see LLP used in the renewable energy sector is that this structure can offer certain tax benefits to landowners when compared against a traditional option and lease structure. I'll now hand over to Ellie, who will be taking us through some of the key terms of a JV agreement.
Thanks, Sarah. So once you've decided to go ahead and form a corporate joint venture, you're going to want to put in place terms to regulate the relationship with your JV partner and the operation of the JV going forward. So listed on the slide here are some of the key terms which are the subject of most negotiation. So when taking you through these terms, we will be referring to a limited company governed by a shareholders agreement and articles of association. So moving on to ownership split. The JV partners are free to determine the split of ownership of the JV company in whichever manner is most appropriate to the commercial circumstances. So an equal 50-50 split in ownership is often selected because it ensures shared responsibility and where the parties are also making a broadly equal contribution to the project. So this is typically what we call a deadlocked joint venture, and I'll talk about this in a bit more detail later. Alternatively, if one JV partner is providing a greater contribution to the JV than the other, so for example, if they may be providing most or all of the funding, this will typically be reflected in the JV company's share capital. So on rights to profits, some of the most important commercial terms to negotiate within your JV agreement is of course the funding and the profit sharing terms, as the purpose of the JV is to develop a project with a view to generate a profitable return for the partners. The rights to receive the profits from a project usually follow the contribution which the partners make to the JV company. So this is usually simply achieved by the profit sharing regime reflecting the share capital structure. So for example, the distributions and dividends are payable pro rata to the JV partner's shareholding. So renewables projects are typically capital intensive in the initial stages, and so any profits are not realised until the project is either constructed and operating, sold on to a third party. So in these cases, profit sharing arrangements will often be dictated by a dividend policy in the shareholders' agreement. Depending on how the project has been funded, the parties will usually restrict the payment of any dividends until either the shareholder loan funding and or any senior debt has been fully repaid. So moving on to management and decision making for directors. As Sarah mentioned earlier, the management and decision making within a JV company is carried out by the board on a day-to-day basis, while the more strategic and commercial decisions are often reserved to the shareholders. The allocation of decision-making rights will often be dictated by the ownership split among the JV partners, and this split will likely fall into two main categories. The first is a 50-50 owned company where the decision-making rights are usually equal, and then the alternative is what we call a controlled JV, and this is where a single shareholder or a group of shareholders will exercise control over the company through voting and other rights. This control usually stems from the ownership of a majority of shares. So if we're focusing on the controlled JV, the controlling party, which will usually be the majority shareholder, will typically seek the final sale matters to be decided at board meetings. And this can be achieved through various board-related rights, including the right to appoint a chairperson with a casting vote, to appoint a majority of directors, or weighted voting rights in favour of particular directors. So for example, those appointed by the controlling shareholder. So while these rights grant significant control, they are not absolute. Minority shareholders will typically reserve certain matters for shareholder approval to protect their interests. And these protections ensure that minority shareholders still have a say in fundamental decisions that could impact their investment. So now moving on to management and decision making for shareholders. Under UK law, if a minority shareholder holds more than 25% of the voting share capital in a JV company, it will have the power to block the passing of special resolutions. So special resolutions are required in a number of circumstances, and this could include a reduction of share capital. It could be disapplying the statutory preemption rights on new share issues, or it could be altering the Articles of Association. However, a minority shareholder cannot block ordinary resolutions, which will be decided by a majority vote, so by the holders of over 50% of the shares. In extreme circumstances, a minority shareholder may apply to the court on the basis of conduct amounting to unfair prejudice by the majority shareholder. However, this remedy is limited and it is rarely satisfactory due to the time and cost implications of doing that. So the types of matters which we see being reserved for shareholder approval in a JV will depend on the nature of the project itself and also the bargaining position of the parties. So as I mentioned earlier, you'll usually see restrictions on altering the articles or the share capital. So for example, something that influences the ownership of the JV. In addition to these, we'll see more commercial and operational restrictions. This could be changes to the funding arrangements. So for example, putting in further shareholder debt or obtaining senior debt and granting of security over the assets of the JV. Could be acquiring or disposing of interested land through a lease or an option, making or altering a planning application, or it could be entering into significant contracts. So for example, something like a turbine supply contract, or maybe contracts over a certain value. In addition, a minority shareholder will often seek a right to appoint a director, supported by perhaps by a requirement that its representative is necessary part of the quorum. So I'll now pass back to Rory, who's going to cover a few of the other key terms.
Thanks, Ellie. As we mentioned earlier, funding and finance is one of the key areas of focus when establishing a joint venture for the development of a renewable energy project. In most JVs, partners will contribute equity proportionate to their shareholding. The bulk of initial JV funding will typically come from shareholder loans, though, rather than through the issuance of new shares. Shareholder loans are usually unsecured, they may accrue interest, and will typically rank behind any senior or secured debt, but they will have to be repaid in full before profits are paid out to shareholders by way of dividend. There will normally be provision for an annual or project budget, which is usually agreed when the JV is formed, in order to avoid debate or dispute if it is done post-JV formation. This will provide for the shareholder funding obligations. The JV agreement will also narrate a cash call procedure, and this is usually linked to the budget, an agreed drawdown schedule, or the achievement of agreed performance milestones. It's vital to have a well thought through and constructed budget with a built-in contingency, clarity regarding KPIs and funding of obligations, with clear drafting as to drawdown timing and milestones. The JV agreement will normally specify the process for obtaining senior debt if required. If this is required, it should be governed by agreed limits and must be on market terms or as outlined in the budget. The JV partners should be aligned in trying to secure the best borrowing terms with a view to maximising their expected profit return. So when the parties do look to take on external or senior debt, lenders will have a number of key considerations for ensuring that a JV is ready to be funded. First, it will be important to establish that the JV agreement is clear and comprehensive, ensuring that it defines partner roles and responsibilities, exit mechanisms, decision-making processes, and dispute resolution processes. Having this clarity will aid in providing lenders with confidence in the operation and management of the JV going forward. Lenders will also want to assess the covenant strength and track record of each JV partner, which may include financial capability, technical expertise, and also local presence and experience. It's important that the partners have a good reputation, which will enhance the JV's credibility and attractiveness to lenders. Another factor is if the projects benefit from stable and supportive frameworks, including government subsidies, such as contracts for difference or access to the capacity markets, and also any long-term power purchase agreements. If a project can demonstrate that they benefit from any of these, then they will evidence predictable revenue streams, therefore reducing financial risk from a funder's perspective. Lenders will also want to consider what technology is being used, if the technology is established, or if it's something like onshore wind or solar. This will improve bankability as emerging technologies likely face higher financing costs or could require grants or government backing, which may be a risk to a lender. An attractive grid proposition is also considered, as projects located in areas with good grid access would be deemed more favourable against projects in congested areas. The risk with projects in congested areas would be that they might attract higher costs or grid delays, which again would be viewed as a risk by a potential lender. Finally, ensuring that you undertake thorough due diligence on your proposed JV partner is essential. Getting to know their ability to fund, where their funding is coming from, and their operational capabilities will help ensure that you're aligned on how you plan to run the project and also reduce operational risk. Sarah's now going to take you through events of default.
So now moving on to the default provisions in the JV agreement. These provisions will outline the events that constitute a default by a partner and the consequence of the default to make sure there's protection, one for the JV and also for the non-defaulting partner. So typical default events include a material or persistent breach of partner's obligations. For example, a failure to meet agreed upon milestones or deadlines, or a breach of confidentiality obligations. A change of control of one of the partners. So this is particularly noteworthy because the other partner will have entered into the JV based on specific expectations of their partner's capabilities and financial covenant. If a partner is acquired or undergoes an ownership change, it is then crucial to seek prior written consent from the other partners. An insolvency event. So if a partner enters into financial distress or becomes insolvent, this will likely be an event of default as they will be unable to meet their financial commitments under the JV agreement. Also just failure to fund. So when a partner fails to meet their agreed financial obligations under the JV agreement, this would likely be an event of default. Also losing regulatory approval. So this can result in the cancellation of necessary permissions, which would potentially impact the JV's ability to conduct regulated activities. And it's also worth mentioning cross-default provisions. And this is sometimes included in the JV agreement. And this is where a default under another agreement, such as a development service agreement, leads to a default under the JV agreement. A developer will typically argue against cross-default under a development service agreement on the basis that its role as a developer is completely separate to its equity stake in the JV. So when a JV partner defaults, the JV agreement typically grants specific remedies and penalties. And the consequences of defaults can include disenfranchisement, so in other words, switching off shareholder or member voting rights. If it is a funding default, then equity dilution may also apply. And this is where the JV agreement may permit issuing additional shares to cover any shortfall which will dilute the defaulting partner's stake. There's also the buyout mechanism, which is when a replacement partner is brought in to take on the existing partner's equity and loans at a discounted market value. It's important to flag that when it comes to enforcing a default, it is usually seen as a last resort, and sometimes just the threat alone will be enough to persuade the defaulting partner to remedy the default as soon as possible. I'll now pass back to Ellie, and she's going to cover deadlock.
Thanks, Sarah. So where parties or appointed directors can't agree is usually referred to as a deadlock matter. So deadlock can arise either in a 50-50 joint venture where the shareholders' appointed directors take opposing views, or perhaps where a director appointed by a minority shareholder has exercised their right of veto. Similarly, deadlock can arise at shareholder level in relation to matters which have been withdrawn from the authority of the board and then require shareholder approval. So possible solutions could include the chairperson's casting vote for a deadlock at board level. As the chair will typically be appointed by one of the shareholders, potentially on a rotation basis, you may ultimately be giving the other shareholder a right of veto with this approach. There's also the options of mediation, expert determination, or arbitration. However, it can be difficult to find someone who's truly an expert, and this is dependent on the nature of the deadlock matter. There's also the option to escalate within the respective entities, so by reference to a party's chair or chief executive. Where the JV partners are large-scale organisations, this can be quite a helpful method of getting the issue in front of the decision maker. However, this isn't helpful where you are dealing with a smaller counterparty, as the senior people will likely already be involved at that stage. So if these remedies fail to resolve the deadlock, the JV agreement may provide for a further stage, which includes some more drastic measures, which would typically look to bring the JV agreement to an end, or at least in its current form. So this can be achieved through the buyout by one of the parties. And a buyout can work in a number of ways, but two common methods that we see being used are called Russian roulette or the Texas shootout method. So under a Russian roulette provision, one party will submit an offer to sell its shares, and that'll be to the other party at a specified price. The other party will then have an option to either buy at that price, or they can reverse it by selling their own shares to the offering party at that price. So this can help to generate a fairer valuation, as you wouldn't offer your shares for sale at a price you wouldn't be willing to pay yourself, because you might end up becoming the buyer rather than the seller. So the Texas shootout method is a variation on the Russian roulette method, and that requires a sealed bidding process by all parties, with the highest offer being selected once all the bids have been revealed. And then, of course, winding up is another option. However, given the fatal nature of winding up the JV, it's something we'd only really recommend is used as a very last resort. So therefore, in the drafting of your JV agreement, it's really important to consider what would constitute a deadlock and making sure you set out a clear procedure and a timeline for resolving it. So we're now going to move on to exit. So there will naturally come a time when one or all the parties want to exit the JV. In the context of a renewables project, some will only want to be involved up to a certain point of that project, like a ready to build. So therefore, it is important to prepare and plan for these scenarios. This could include a lock-in period, which would restrict the parties from transferring their interests until a certain period of time has passed. In doing so, that would help ensure the parties are committed to the JV and making sure you have some certainty on the people that you're working with. The JV agreement should also provide for some circumstances in which transferring the interest would be acceptable, and equally where that would be prohibited. So intragroup transfers are typically permissible. However, you should also be mindful of whether the new counterparty can fulfill the obligations of the outgoing party. It's also sensible to exclude the transfer to any specific parties, such as competitors. And JV agreements often include rights of first refusal, so where if you propose to sell your interest to a third party, you have to allow your JV partner to match that offer. This can be quite challenging, as a third party would be reluctant to invest time and resource into entering into a JV, only for that opportunity to be taken away by the existing JV partner. So I'll now pass back to Rory to finish up and to tell you a bit more about our upcoming sessions.
Thank you, Ellie. That concludes our overview on joint ventures and corporate structures. As I mentioned at the start of the call, our session today has been recorded, and you'll shortly receive an email with a link to the recording of the session. In that email, you'll also find a link to register for further sessions and learn more about the programme. The upcoming 3 webinars in the series are highlighted on the screen just now. Our next webinar takes place on the 28th of August, where some of our colleagues will be discussing agricultural and crofting considerations for energy projects, which will include a section on drafting for natural capital benefits. In the meantime, if you'd like to hear more about any of the topics covered today, or if you have any specific queries for us, do reach out to one of the team. We'd be delighted to hear from you. And thanks very much for your time today, and we'll hopefully see you all at future sessions.